All the builders are down on the latest bout of bad news from luxury builder Toll Brothers. This even as mortgage rates are dropping today because they follow the yield on the 10-year Treasury. Usually builders get a bounce off of that. Now, Toll reported new orders down 13% from a year ago, and the value of those new orders down 15%. It also gave lower expectations for 2019 than the street was expecting, citing higher mortgage rates. Interesting, CEO Doug Yearley shared the blame, saying, "In November, we saw the market soften further, which we attribute to the cumulative impact of rising interest rates and the effect on buyer sentiment of well-publicized reports of a housing slowdown."
We've been seeing a slowdown in housing all year, but this is the first time that Toll Brothers really acknowledged it in a press release. I think up to this point, they've felt like they're somewhat immune, being on the upper end of the market where people are less sensitive to changes in mortgage rates.
Reports from the home builders, the U.S. Census, the realtors, Fannie Mae have all seen weakness in home sales and pointed squarely to the combination of overheated home prices and higher interest rates, pushing affordability to the weakest level in a decade. Toll's average sale price is about 3 times higher than the national average. Toll cited the weakest demand in California, where home prices are highest. So really, it's just that buyers have hit the wall of what they're able or willing to pay. If you'd like to see any of those reports, they're on CNBC.com, along with which local markets are hit hardest in the luxury sector. Back to you guys.
Diana, real quickly on that point, plenty of people are asking today, what is the mix of reasons why we're talking about housing market weakness for Toll? I mean, is it because in the Northeast you have some property tax issues, you have the loss of the or are we talking about something that applies economy-wide?
It's economy-wide, and look, it's not just salt, because Toll Brothers actually gets most of its revenue from California, where you're looking at the highest prices in the nation, and you're not seeing those prices come down very much. And it's also, look, you have high-end home buyers who are perhaps in the stock market looking at volatility, looking at growth in the economy, all weighing down on them. And they look at this being an incredibly large investment, and many are now starting to ask, if I buy a home now, am I going to lose money next year if prices really start to weaken because of that demand? Is it a bad investment?